And I'm here today with Charles Plowden from Baillie Gifford, the retiring senior partner, or perhaps not very retiring senior partner. I wanted to ask you, first of all, what has lockdown been like for you doing the job of a fund manager?
Slightly flippant answer, but as a practice run for retirement and spending more time at home with my family, it's been very helpful. But from a performance perspective, it's just been a miraculous year for Baillie Gifford. We've had massive outperformance built on a worldwide reputation. What are we in our third lockdown? And I'm worrying about the culture, which particularly for Baillie Gifford, we are very different and unlike other places. And it is hard to integrate new joiners, and we are still a growing firm. It's hard to train youngsters, which is how we prefer to do our recruitment. So I think as soon as we're allowed to, instead of rushing off on holiday, we're all going to be rushing to the office to have sort of group hugs and team meetings.
And that differentiation has been particularly noticeable in the investment trust world, where you've had significant success with Scottish Mortgage, with Monks, and you're about to take on the Keystone brief, or mandate, should I say. Where do you see that whole investment trust industry going? I mean, it's had a great revival in recent years. Is there more?
Yeah, I think we have to, accept it is a revival from a pretty depressed point. I mean, when we started our careers, investment trusts were probably, a much larger part of public savings than they are today. And then the whole unit trust movement sort of came and they spent billions or millions on marketing. And actually, if you think about it, the unit trust is disadvantaged relative to investment trusts. Investment trusts have a wonderful structure. So they're typically cheaper than a unit trust. They typically perform better because research shows that in any sector, the Japanese equities, the investment trusts tend to do better than the unit trust. They have more freedoms, they have board oversight, independent boards, and they can borrow money to gear up the upside, which over the long term pays off. So I think structurally they're really well placed. I think they are getting more attention. I think having Scottish Mortgage in the FTSE and actually being last year's the best performer in the FTSE is helpful for the whole industry. But they're still small. And from our point of view, the other advantage, of course, is that being permanent capital, they can invest in less liquid asset classes, less liquid companies, and increasingly in unquoted companies. So all of these are advantages that most other, certainly retail or accessible to the retail investor vehicles can't do. So I would hope that they've got a healthy future. I don't know, from our perspective, we've now got, I think it's 12 investment trusts. Pretty crowded, so we haven't got huge scope for introducing new funds. But maybe it's a structure that could be taken overseas, that Americans or Germans or Australians could start to be taught about the attraction of investment trust, closed-end investment trust.
I wanted to ask you about ESG now. How much has that affected your sort of investment process and the decision making, whether to buy or hold a stock?
I mean, clearly, increasingly, it's definitely rising up the agenda, and I think that's not just due to sort of pressure. That's due to self-interest. Because if you think about it, we're long-term investors, and we want to invest in businesses that have a sustainable, secure future. So sustainability with a small s. Will this business still be there in 10 years? Will it still be popular with its customers, with its suppliers, with its workforce? So I think ESG as a sort of broad concept, companies have to behave responsibly. They have to work with the grain of society. And I think some of the bad, particularly on the E and the S, doing social harm or being damaging the environment, those are going to actually become financial liabilities in time. And particularly the environmental. If they introduce carbon taxes or carbon pricing, the bad polluters, their costs are going to go up. So we feel quite strongly that companies need to get ahead of these wider expectations. So there is a positive message behind the move to ESG. But I think the way it gets implemented is very complicated. So one, I think that the G, the governance focus, which has really been what people are preoccupied, board structures and, board representation and rotation and independence and so on. I think there's been a lot of focus on that, probably too much. And the culture of a business, which is really part of governance, gets ignored. So it becomes a box ticking. How long has your board director been on the board? And the difficulty with the E and the S, the environment and the social, is how do you measure? What data, what's the management information that people look at? And I think at the moment, we're just at that position where there's too many competing approaches. Many of them are sort of automated, box ticking. We do need better information from companies. And I think we and others will continue to press companies for better information. And then when we've got the information, then we can try and come up with some sensible standards. So I think it is increasingly important, but not in a ESG way, but in a, is it sustainable way? It's going to be an increasing factor in a company's success.
And one of the things that we've been focusing on helping clients is obviously how to communicate ESG and how to communicate generally. In your time at Baillie Gifford, what do you think were the most important things in terms of how companies communicated, not just to the market and investors, but stakeholders generally?
I mean, that's quite a difficult one for me because, of course, I'm in a privileged position that as major institutional investors, we tend to have direct access to senior management. So if we want to talk to the finance director or the CEO, usually, or indeed the chairman, we can just pick up the phone and arrange a call. And particularly under lockdown, we have found our company senior executives are much more available to us. So instead of having to book up a meeting, a month or two in advance, we know where they are. They're at home. the sorry, he's on a tour of China line doesn't really sort of hold up at the moment. So we tend not to communicate through the company's, outward-looking communication strategies. I would probably, though, make a couple of generic points. One, don't over-communicate. It's always horrified me how much time and effort chief executives in particular put into meeting with shareholders and talking. And some of them, offer to come around every quarter. And I think that's far too often. Once a year, a proper in-depth conversation should be enough. And a company should be very clear what its plans are, what its mission is, how it's running itself, where it sees the opportunities. Be very public and open with that, and then just get on with it. And an annual report is much better than a quarterly report. So, and I think Americans generally are better than this, but Americans have this hideous thing of quarterly reporting and the requirement to report financial information quarterly, even if they don't have to do the full sort of quarterly presentations. And we try and discourage them from getting focused on quarterly. And please don't bother too much with guidance. I mean, guidance, particularly quarterly or half-yearly guidance, is really unhelpful. It doesn't really help us because we become spoon-fed. But it really doesn't help the company either, because you can't manage a business, and I know this because I've sort of been involved with running a business, with quarterly or even annual targets. You need to have a target. Over the next X years, we hope to get to this point. But you can't do it year by year. I think that's very damaging. And it affects, spending plans and makes people invest for the short term, not for the long term. And then it's very hard to get long-term results as a result of short-term investment. Yeah, so that's a long way from communication, but I think it's all part of the same. Don't talk about it too much. Just get on and do it.
And that short-termism thing has always been a great criticism, hasn't it, of the market, in terms of it sends the wrong messages to companies, that you have to meet your quarterly earnings estimates. And then, as you say, they take the wrong decisions.
Definitely. We used to talk to our clients, show our clients a lovely graph comparing Walmart with Amazon. And Walmart has met quarterly expectations 88% of the time over the last 20 years. Amazon has only met quarterly expectations something like 40 times, 40% of the time over the last 20 years. But then you look at the share price performance and the relative value that those companies have created. And meeting, Walmart is designed to meet quarterly guidance. It's not designed to grow.
That's really, really interesting. And it brings me on to the thought about the influence of the media and whether a fund manager, just in his day-to-day or her day-to-day existence, reading media, seeing things on the TV, whether that then ultimately has an influence, in terms of the decision-making process, or whether it's kind of more just noise in the background, or whether true investigative or opinionated journalism can actually influence the buy-sell hold decision.
Well, I think most fund managers, not all, because a lot of it's now done by computers, but most of us are human, and we are going to be influenced by what we see and read, and particularly what we're repeatedly seeing and repeatedly reading. So I think it is important to have a balanced media profile and not just let negative stories run wild without being addressed. I don't really want to be reading about my investments, on Twitter every day. And I think it's the one we as some of your viewers might know, have been big investors in Tesla. But the biggest pain in the last 8 years has been Elon Musk tweeting. And we could really have all lived without that.
That Tesla success, for which you're as a firm extremely well known, and it's in part what's driven the great success of Scottish Mortgage. Has that been one of your kind of proudest investing moments of the last 30 years, or are there some other ones that you'd highlight, either from a personal basis running the business, or in terms of the successes?
Well, this is, obviously my whole career, Reg, has been just one after another proud moment.
Yeah.
I think, I have been very lucky, and I've worked for a successful firm for a long time, and that in itself brings its own, own reward, shall we say. But I think what has really made me most proud is it's not actually Tesla. I bought Tesla at $7 for my clients. Sadly, not for myself. I don't know quite why, but anyway. But it's really the accolades, how well the firm has done across virtually all remits, all mandates over recent years. So, Forbes magazine, which I'm not a subscriber, but I'm sure it's very, very honorable. They described us as the world's best stock picking firm. And as the partner responsible for the investment team over the last 15 years, I think that has to take the biscuit. And I would say we do have a no stars approach. So everything is about teamwork and culture. And I think the results that we've produced is a collective effort. But I've been somewhere herding the cats in the right direction. So no, it's got to be that.
Stocks like Tesla, which have been such a success, are rated on stratospheric numbers. To what extent do you think we might just be in a sort of a bit of a bubble? I mean, the media have particularly been talking about a US bubble.
Yes, well, we could argue for hours about whether stratospheric multiple of what. And I remember in 1990, people telling me Microsoft was massively overvalued. But of course, the world's most successful businesses grow into their valuations. And is Tesla on a stratospheric multiple of what the profits it might make in 10 years' time? We don't think so. So is it on a much higher multiple of what it might make in 10 years' time? Undoubtedly. So it's a lot less cheap than it was a year ago. But does that make it a bubble? I mean, we're not sure. Some markets have gone up. I did notice that the FTSE again is still at the same level that it was at 20 years ago, or in fact 22 years ago. I think it's slightly above where it was in 2001. But so the FTSE is, to claim that the FTSE is in a bubble would be a bizarre statement, I think. There are certainly some signs of heat. The IPO market's very hot. We're getting some fun and games now from retail investors, which is often associated with sort of frothy markets. But we also think that some businesses and their opportunities have expanded hugely, and in many cases, we can justify those valuations. And it is worth remembering that with interest rates very low as they are and bond yields so low, it's quite hard to work out how you value. That they're more expensive than they used to be, but they're a lot cheaper than a bond. Now that may not be very reassuring. I also think market prices are very rarely right or accurate, and I don't think one should, one shouldn't trust any one day's share price as telling you, containing any information at all. And many of the best long-term winners suffer severe drawdowns. I think Amazon and Tesla have both seen sort of probably double-digit falls of 30% in their share, drawdowns of 30% in their share price, and it means nothing in relation to the long-term opportunity. So I don't think it's a bubble. I think that's quite a strong word to use, but I think a pause would be helpful for us all to sort of grow into our current valuations. And there are frothy, I can't even say the word, but there are some sort of elements around the edge that I wouldn't trust too much. So holding a bit of cash probably isn't a bad idea at this point, but I certainly wouldn't go out and sell all my investments.
Thank you very much on behalf of myself and MHP for participating in our podcast today. We wish you all a very happy and productive retirement, and we obviously hope to see you in person in the near future.